Hello and welcome. In this presentation, we will look at how we can translate cost information to financial performance information. We'll specifically consider strategic profit model, also called DuPont model, to understand this process. Now, the cost flows within companies is such that we take these individual cost elements and then we are showing them in our financial reports, whether it's the balance sheet or income statement. So for instance, the material purchases will fall under raw materials, and those are inventories which fall under the assets section of our balance sheet. Direct labor and manufacturing overhead would come under work in process inventories. Again, they are part of the assets section within balance sheet. And then finished goods are inventories, again, part of the assets. When we sell these finished goods, we have cost of goods sold, which comes in income statement. The short-term expenses are part of the selling and administrative costs, and the capital asset that we have also fall under what we call plant, property, and equipment, and again, part of the selling and administrative expenses. So that's the way our costs are being reflected in financial reports, whether it's balance sheet or income statement. I will take example for Walmart and Tiffany. It's an illustrative example to understand how we can determine their overall profitability, their asset turnovers, and understand how companies could be doing different things yet reaching the final outcome similar to each other. So we have information on sales, cost of goods sold, operating expenses, interest expenses, taxes, and with all that, we can find net profit after tax, like we see here. And this is something which we will also see as part of our profit margin model, which is shown here. So we have the net sales, and all the purple numbers are for Walmart, black numbers are for Tiffany. So if we take a look at the way these costs are, we have, first of all, the sales values. And from the sales, when we remove cost of goods sold, we get gross margin. And likewise, we can also add the operating expenses and interest expenses to get total expenses. When we subtract total expenses from gross margins, we get net profit before tax for the two companies. Subtracting taxes gives us net profit after taxes. And when we divide that net profit after taxes with net sales, we get the net profit margin, which is 3.18% for Walmart and 7.68% for Tiffany, based on the information that we have here. Now, similarly, we can also calculate the asset turnover for these companies. We take the information from balance sheet, accounts receivables, merchandise inventory, cash, and other current assets, add them, and we get the total current assets for the two companies. And then when we add to the total current assets, fixed assets, again coming from balance sheet, we know what the total assets for the companies. And now, knowing what the net sales of these companies are and what their total assets are, if we divide net sales by total assets, we will get asset turnovers. And here we can see the asset turnover of Walmart happens to be higher than that of Tiffany. So we know that we are, especially in the asset turnover, what we're looking for is every dollar sales generated by each dollar of assets invested. On that front, Walmart has been doing better. Profit margin wise, we looked at the net profit margin, and there Tiffany was doing better. Using this information that we calculated, we can find return on assets by simply multiplying net profit margin with asset turnover. And we see for Walmart, it's 8.84, and for Tiffany, it's 8.525. And these numbers are pretty close. So although Walmart and Tiffany clearly have very different marketing, merchandising strategies, we know these in terms of their customer profile, they end up with approximately the same return on assets. Now, similar idea that we just did for calculating return on asset can also be extended to look at the return on equity, which includes leverage choices as part of the mix. And that's where we take a look at the return on investment model, including the strategic profit model. So at the top of this dotted line, we have the net profit margin that we had calculated earlier. The bottom side, we have the asset turnover, also something which we just looked at. When we multiply net profit margin with asset turnover, we get return on assets. And when that return on assets is multiplied with financial leverage, that's when we get return on net worth. Right? So this is something which once we have information on financial leverage, we can also know what the return on net worth will be for a given company. So that's how the strategic profit model looks like. We have income statement information coming here. We have the balance sheet related information that are showing up in yellow, and all the pink color boxes are part of the strategic profit model that determines how all these costs are eventually turning into return on assets or return on net worth. So overall, this information helps companies understand where there are opportunities for improvement as against the remaining companies in the same industry, how they've been performing, and all that is valuable when we are structuring our costs to become more competitive. Thank you.